I've spent 35 years in global macro. I've worked at Goldman Sachs. I've run hedge funds. I've watched every central bank policy shift, every liquidity crisis, every credit cycle you can imagine. And what I'm about to share with you is one of the most significant regulatory changes I've seen in my entire career. On January 15th, 2026, the Federal Reserve published an updated framework for reserve requirements, and what it says fundamentally changes the relationship between your cash deposits and the banking system. This is not speculation. This is not theory. This is a regulatory change that has already been implemented, and it tells you something critical about what the Federal Reserve sees coming. Before we dive in, subscribe and hit that notification bell. This is the kind of structural analysis that changes how you think about the entire financial system. And if this resonates with you, share it with someone who keeps significant cash in the banking system. The framework you need to understand. Let me start with the fundamental framework that governs every financial system in history. It's called fractional reserve banking. And if you don't understand this, you cannot possibly grasp the risk you're taking by keeping significant wealth in the traditional banking system. Fractional reserve banking means that banks do not hold all of your deposits in cash. They hold a fraction and they lend out the rest. This system works beautifully when confidence is high and defaults are low, but it collapses catastrophically when depositors lose confidence and attempt to withdraw their money simultaneously because the cash simply does not exist. The reserve requirement is the regulatory guardrail that's supposed to prevent this collapse. It's the percentage of deposits that a bank must hold in liquid reserves, either as physical cash in the vault or as deposits at the Federal Reserve. Now here's what you need to understand about the current situation in March 2020. At the onset of the pandemic, the Federal Reserve made an emergency decision to reduce reserve requirements to 0%. Banks were allowed to lend out 100% of deposits with no reserve buffer whatsoever. The justification was that the economy was in freefall and credit needed to flow freely. That emergency measure was supposed to be temporary. But here's the thing, according to the Federal Reserve's own documentation, reserve requirements remain at 0% as of January 2026. Let me repeat that, your bank is not legally required to hold any reserves against your deposits. The cash you think is sitting in your account, it's not sitting anywhere. It's been deployed into the lending market, into securities purchases, into repo agreements, into the complex web of financial instruments that generate profit for the bank, the everything code and banking in the everything code. I talk about how liquidity is the master variable. Liquidity drives everything. Asset prices, credit availability, economic growth. And what the current reserve regime tells us is that the Federal Reserve has prioritized maximum liquidity deployment over systemic safety. Think about what this means in practical terms. If you deposit $100,000 into a checking account at a major commercial bank, that bank has no legal requirement to keep any of it available. All $100,000 can be immediately deployed into the lending market, and here's the critical point: that $100,000 you think is yours, it's now somebody else's loan, somebody else's mortgage, somebody else's corporate bond. It has been relent multiple times over through the money multiplier effect. If you and everyone else with deposits at that bank decided to withdraw your money on the same day, the bank would have essentially nothing for every dollar in claims. That shortfall can only be covered by emergency borrowing from the Federal Reserve. This is not a flaw in the system. This is how the system is designed to function. And the Federal Reserve has made it more fragile by maintaining zero reserve requirements during a period of elevated systemic stress. Why this matters right now? Now let me explain why this matters specifically in this macro environment. Because timing is everything in macro. The United States is carrying over $36 trillion in federal debt. Corporate debt has exceeded $13 trillion. Household debt is approaching $18 trillion. We are sitting on the largest debt pile in human history, both in nominal terms and as a percentage of GDP. And that debt was accumulated during a decade of near zero interest rates when borrowing was essentially free, but rates are no longer near zero. The Federal Reserve raised rates aggressively in 2022 and 2023 to fight inflation. Even though they've paused since then, the current federal funds rates, it's at 3.5% to 3.75%. The damage has been done. The cost of servicing all of that debt has exploded. Corporations that borrowed at 2% are now refinancing at 6% or 7%. Governments that issued bonds at rock-bottom yields are now facing fiscal stress as interest payments consume larger portions of tax revenue. Consumers who took out variable rate loans are seeing their monthly payments increase significantly. This creates what I call a deflationary feedback loop. Higher debt service costs mean less money available for consumption and investment. Less consumption means weaker economic growth. Weaker growth means lower tax revenues and higher default rates. Higher default rates mean banks take losses on their loan portfolios. And when banks start taking losses. They pull back on lending, which makes the deflationary spiral worse. The Federal Reserve knows this. The unrealized loss problem. Now let me show you the number that should terrify anyone who understands banking mechanics. According to FDIC data, U.S. banks were holding approximately $400 billion in unrealized losses on securities as of the third quarter of 2025. That's down from over $500 billion at the peak, but still elevated. That's your deposits backing assets worth significantly less than their book value. And remember, these banks are operating with zero required reserves. Here's the mechanism that most people miss. When a bank holds assets that have lost value, those assets remain as liabilities on the bank's balance sheet at full face value. Your deposit is still a $100,000 liability, but the securities backing it might only be worth $80,000 or $70,000. This creates an instant solvency problem if depositors try to withdraw. The bank has to sell assets at a loss to raise cash, which makes the solvency problem worse. And if other depositors see the bank selling assets at a loss, they panic and try to withdraw too, which forces more asset sales at even steeper losses. This is the classic bank-run dynamic. It's exactly what happened in March 2023 with Silicon Valley Bank, Signature Bank, and First Republic, the 2023 banking crisis. A lesson. Let me walk you through what happened in 2023 because it's directly relevant to today. In March 2023, Silicon Valley Bank collapsed in the second largest bank failure in United States history. It was followed by Signature Bank and First Republic all within a matter of weeks. The proximate cause was a classic asset-liability mismatch. These banks had loaded up on long-duration treasury bonds and mortgage-backed securities during the zero-rate era, and when rates spiked, the market value of those bonds cratered. The banks were technically insolvent on a mark-to-market basis even though their depositors had no idea. When word got out, depositors ran, and the banks collapsed. The Federal Reserve and the FDIC intervened with emergency backstop facilities, guaranteeing deposits above the $250,000 insurance limit and providing liquidity to other regional banks to prevent contagion. That intervention worked in the short term. The panic subsided. But here's the question you need to ask yourself. Can they do that again? The political environment has changed. There is significantly less appetite for bank bailouts than there was in 2008 or even 2020. The debt levels are higher, which constrains fiscal flexibility, and the public is far more skeptical of interventions that seem to benefit Wall Street at the expense of Main Street. The Bank Term Funding Program extension. At the same time that reserve requirements remain at zero, the Federal Reserve has extended the Bank Term Funding Program through June 2026. The BTF was created as an emergency facility during the March 2023 banking crisis. It provides liquidity to banks that need to borrow against their securities portfolios without having to sell at a loss. It was supposed to be temporary, but it's now been extended 3 times. That tells you banks are still under stress. They're still relying on Fed support to maintain liquidity. Meanwhile, commercial real estate delinquencies are accelerating. According to industry data, delinquency rates on commercial mortgage-backed securities hit elevated levels in late 2025, the highest since the post-financial crisis era, and regional banks hold approximately 70% of all commercial real estate loans in the United States. When those loans start defaulting, the losses flow directly onto bank balance sheets, which are already strained by unrealized losses on securities. Historical precedents. Let me give you the historical context, because this is not the first time reserve requirements have been used as a crisis management tool. In the lead-up to the Great Depression, reserve requirements were inconsistent and often inadequate. Banks operated with thin capital buffers. When the stock market crashed in 1929, and the economy contracted, depositors lost confidence and rushed to withdraw their funds. Between 1930 and 1933, over 9,000 banks failed, wiping out the savings of millions of Americans. The Federal Reserve was created in 1913 in part to prevent exactly this kind of cascade, but in the early 1930s it failed to act as a lender of last resort and the banking system collapsed. The lesson learned from that catastrophe was that reserve requirements matter. They are a critical buffer that prevents isolated shocks from becoming systemic crises. In response, the Banking Act of 1933 created the FDIC and established standardized reserve requirements to ensure banks maintained adequate liquidity. For decades, those requirements provided stability. But over time, as financial markets evolved and banks became more sophisticated, the requirements were viewed as archaic constraints on profitability. The deregulation wave of the 1980s and 1990 seconds chipped away at those standards. The 2008 financial crisis was the inevitable result. Banks had leveraged themselves to absurd levels, and when the housing market collapsed, the entire system nearly went down with it. The response was supposed to be a return to prudence. Dodd-Frank and Basel III regulations were implemented to increase capital requirements and reduce leverage. But here we are in 2026, and the Fed has maintained zero reserve requirements at a time when systemic risk is arguably elevated. What this means for you, so what do you do with this information? Let me give you the framework I use for positioning in this environment. First, understand that your bank deposits are not risk-free assets. If you have deposits above the FDIC insurance limit of $250,000 in any single institution, you need to understand that you are an unsecured creditor. In a bank failure, you could lose access to those funds or have them converted into equity in a failing institution under bail-in provisions. The action is to spread deposits across multiple institutions to stay under the insurance limit or to move excess funds into assets outside the traditional banking system. Second, this is exactly the macro environment where hard assets make sense. In the Everything Code, I talk about how liquidity expansion drives asset prices. We're entering a period where the Fed may be forced to provide emergency liquidity again, which means more currency creation, more debasement pressure. Gold, silver, and Bitcoin function as insurance against exactly this scenario. They have no counterparty risk. They cannot be diluted by a central bank printing press. They cannot be bailed in by a failing institution. Central banks around the world understand this. In 2024, central banks purchased over 1,000 metric tons of gold, one of the highest annual totals on record. China, Russia, India, Turkey, and Middle Eastern sovereign wealth funds are all accumulating. They understand that in a world of fiat currency debasement and systemic banking fragility, hard assets are the ultimate reserve. Third, reduce your exposure to long-duration financial assets. In an environment where reserve requirements are zero, credit risk is elevated, and inflation remains above target, locking in low fixed returns for 10 or 20 years is a guaranteed wealth destroyer. Move into shorter duration, higher quality, or inflation-linked alternatives. The bigger picture, let me zoom out and give you the macro framework for what's happening. The global financial system is over-leveraged. The debt levels are unsustainable at current interest rates. Something has to give. Either rates come down significantly, which risks reigniting inflation, or the debt gets restructured, which means defaults and losses, or the currency gets devalued, which means your purchasing power gets eroded. There is no fourth option. The Federal Reserve knows this. That's why they're maintaining zero reserve requirements to give banks maximum flexibility to manage through what's coming. But that flexibility comes at the cost of systemic safety. Your cash is no longer sitting in a vault. It's actively being leveraged on a bank's balance sheet, and the buffer that protected you from bank runs and systemic stress, it doesn't exist anymore. The investment implication here is how I think about positioning in this environment. The exponential age thesis says that we're in a period of rapid technological transformation, AI, blockchain, biotech, that's creating asymmetric opportunities, but it's happening against a backdrop of financial system fragility. The winners in this environment are assets that benefit from both liquidity expansion and technological disruption. Bitcoin is the obvious example. It's a hard asset that benefits from currency debasement. It's a technology network that benefits from adoption growth, and it exists outside the traditional banking system. Gold is another. It's been money for 5,000 years. Central banks are accumulating it at record pace. High-quality equities in sectors with pricing power, energy, infrastructure, healthcare can protect purchasing power in an inflationary environment, and short-duration fixed income protects against the interest rate risk that destroyed bank portfolios in 2023. The goal is to position for multiple scenarios because we don't know exactly which one will play out, but we know the current system is unstable. We know the guardrails have been removed, and we know that your cash is no longer just your cash. It's leverage. Final thoughts, let me leave you with this. The Federal Reserve does not maintain zero reserve requirements because the banking system is healthy. They maintain zero reserve requirements because they're trying to prevent the credit mechanism from seizing. They're giving banks every possible tool to work through elevated losses without triggering a systemic crisis. But that tool, maximum leverage flexibility, is a double-edged sword. If everything goes well, banks muddle through and the economy avoids a hard landing. If something goes wrong, a wave of commercial real estate defaults, a geopolitical shock, a liquidity crisis, the lack of reserve buffers means the system has less capacity to absorb the shock, and the last time I checked, unexpected shocks are not exactly rare in global macro. So ask yourself this question. Knowing that your bank has no legal requirement to hold any reserves against your deposits, do you feel confident keeping the majority of your liquid wealth in the traditional banking system? Or does this change your risk assessment? If it changes your assessment, what specific actions are you going to take this week? Drop a comment. I read every single one. If this analysis gave you a new perspective on the financial system, hit that like button. Subscribe if you haven't. Turn on notifications. Share this with anyone who keeps significant assets in banks and trusts that their deposits are safe simply because they've always been safe. The rules have changed. The buffer has been removed. Your cash is leverage on a bank's balance sheet. The only question is whether you're going to act while you still have the optionality to move, or whether you're going to wait until the exits are crowded and the liquidity has dried up. This is the exponential age. The opportunities are massive, but so are the risks if you don't understand the system as it actually operates. Stay sharp, stay informed, and position yourself accordingly. I'll see you in the next one.